Hello and welcome. In the previous lesson, we learned about journal entries. We learned that journal entries are just the recording of financial transactions. All journal entries we recorded are normally kept together in what we can call journal book. Of course, you could use any name of your choice as long as it is representative. Our book looks good, but it misses the date for each transaction. The date or time is extremely important in accounting. By law, we have to record transactions in timely manners. But more important, recording transactions in timely manners is necessary for business owners to understand and evaluate the performance of their business. Also, the date of transactions is important for many other reasons. For example, remember that your credit supplier requires payments within a defined period of time. If you don't record the date, how could you tell when the payments are due? The same applies to your receivables. In this lesson, we look into the income statement that we briefly discussed in our third lesson. We will first add a few more transactions to our previous lesson. To our first transaction, you sell 9 bags of cement for $1,500 in cash. We record the transaction. We debit cash and credit cement sales with $1,500. We also debit the cost of cement sales and credit inventory with the cost of $900. Remember, the cost of each bag is $100. This time, the customer picks up the cement, so there is no delivery cost. To our second transaction, you transfer $1,700 of your cash into the bank account you just created with ABC National. We add the bank account to assets and complete the transaction. We debit the bank account and credit your cash balance. To our third transaction, you buy iron rods on account. You buy them from a different supplier, so we have to classify your trade payables. We create 2 sub-accounts, one for the existing supplier and one for the new one. Mrs. Perry is a successful businesswoman. She agrees to provide you with a credit facility, buy now and pay later in 1 month. Now we have 2 products, cement and iron rods. Therefore, we create 2 sub-accounts under inventory. You buy 3 bundles for $500 each. The total is $1,500. We debit iron rods under inventory and credit Mrs. Perry under trade payables. Note that the balance of trade payables represents the sum of the 2 sub-accounts. When we calculate the total of liabilities, we can either consider the main account balance or that of the sub-accounts, but not both. The same applies to the balance of your inventory. Next, you sell 1 bundle for $700 on account. Since we only have a cement sales account, we have to create one for iron rods. We create a sales master account and include cement sales under it. We also create a sub-account for iron rods sales. We do the same for the cost of sales. This categorization directly depends on the number of products and product groups you have, as well as your preferences. For example, if you start trading food items such as sugar and rice at a later stage, then you would have 2 subgroups under the main sales account, one for building materials and one for food items. All looks good, so we record the sale transaction in the same manner as before. We debit trade receivables and credit iron road sales with $700. We also debit cost of iron road sales and credit iron rods inventory with the cost of $500. You pay $50 in cash for delivering the sale, so we record it. We debit delivery costs and credit cash. To this end, let's have a closer look at your equity. Can the classification be improved? Indeed it can. Since we are listing accounts of the same nature together, we need to merge the 2 equity contributions under one group. We extend the balance sheet downward to get more space and merge the accounts. Let us continue. At the end of the day, you receive a call from Mr. Kamara offering 3 bags of cement for a bargain price of $50 each. You immediately buy them on account. Remember, the cost of the 7 bags you had in hand is $100 each. We record the transaction. We debit cement inventory with $150 and credit Mr. Kamara's account with the same amount. Now you have 10 bags of cement with a total value of $850. You sell 2 more bags for a total of $300 in cash. We debit cash and credit cement sales. But what cost should we consider? Is it the initial 100 per bag or the recent 50? In our example, we could easily tell that the bags we sold are from the recent ones. But in real life, sometimes it's very difficult to tell. In any case, in accounting, we have three options. To make the idea clear, we will use an example where you buy 6 bags of cement over 2 purchases. The first 3 bags cost you 100 each, and the second 3 cost you 50 each. Let's assume that you sell 2 of these 6. This time, the sale price is irrelevant because we only need to calculate the cost of sale. The first option we have is to use the first in, first out method. This means that irrespective which ones we sell, whether those that were acquired through the first or second purchase, we consider the cost of cement that arrived first. In this case, the cost of the 2 bags would be 200. If you sell 3 bags, the cost would be 300. If you sell 4 bags, then the cost would be 350. 3 at 100 each and the remaining 1 at 50. We could alternatively use the last in, first out method. In this case, if you sell 2 bags, the cost of the 2 bags would be 100. If you sell 3 bags, the cost would be 150. And if you sell 4 bags, then the cost would be 250. 3 at 50 each and 1 at 100. The third option we have is to use the average cost method. In this case, we divide the total 450 by 6 in order to get the average cost per each bag. This leaves us with an average cost of 75 per bag. If you sell 2 bags, the cost would be 150. If you sell 3 bags, the cost will be 225 and so on. Choosing the right method depends on your preferences. Sometimes the law or circumstances may force you to use a particular method. For example, if you sell products that have a critical expiry date, you are more likely to deliver the items that arrive first because they would expire first. In this case, the first in, first out costing method would suit you best. It is important to note that accounting programs allow you to choose the method you want. Hence, the costing calculations would be automatic. In this lesson, we will consider the average costing method. You had 7 bags with a total of 700, and you bought additional 3 for 150. This means that the average cost per bag is 85. Since you sold 2 bags, the cost of sale would be 170. We continue recording the transaction. We debit the cost of cement sale with 170 and credit cement inventory with the same amount. You also pay 50 in cash for delivering the sale. We debit delivery costs and credit cash. To our next transaction, your credit customer pays the balance. He transfers the balance into your bank account. Therefore, we debit the bank account and credit trade receivables. To improve your business, you decide to take it into the next level. You decide to broadcast a radio advertisement to raise awareness of your business in the area. The ad costs you 150 in cash. Do we have any account where we record such transaction? No, so we have to create one. We debit the advertising expense and the credit cash. Unfortunately, due to water absorption, one cement bag gets damaged. We create the account as in one previous lesson. Since we are using the average inventory costing method, we consider the cost of this one bag as 85. We debit the inventory damage expense and credit cement inventory. To our last transaction, you decide to hire someone to help. Among the applicants, Mars looks the best fit. You agree on a $2,200 monthly salary. You sign the contract 1 week before the end of the month. At the end of the month, you transfer the 1 week salary of $550 from the company bank account into Smart's bank account. This means that your assets will go down. What is the reason behind this decrease? It is a human capital cost or salary expense, and it has to do with the operations of your business. Do we have any account where we record transactions of such nature? No, so we have to create it. We debit the salary expense and credit the bank account balance. With this entry, we complete all transactions for this lesson. As we learned from lesson 3, the accounts under equity that have to do with the business form the income or profit and loss statement. These accounts are related to your business activity and their net shows your profit or loss. Let's classify them. We keep the sales account on top. Under it, we first put costs that are directly related to sales. In other words, the costs that wouldn't occur except if there are sales. Let us look at them one by one. Would the cost of sales occur if there are no sales? Of course not, so we keep it in its location. Do you have to pay delivery costs without sales? No, so we keep it also in its location. How about advertising expense? Do you have to pay the amount in any case or only if there is a sale? You have to pay it in any case, so we move it downward. How about the inventory damage expense? It is not directly related to the sales you make, so we keep it under advertising expense. How about the payroll expense? If you make no sales, do you still have to pay the salary for smarts? Of course you have, so it's not directly related to sales and we keep it in its location. The sum of the above group is called the gross profit. Gross profit is equal to sales minus direct costs. On the other hand, the net profit is the net of the gross profit and indirect cost or expense. But why does such a classification matter in your opinion? It matters because if the gross profit is a credit and your net profit is debit, then you can probably turn the negative net profit into positive by either increasing your sales or cutting down your indirect costs. On the other hand, if your gross profit is debit, you have either to increase prices or reduce direct costs. The importance of this classification is that it allows you to make informed and suitable business decisions. Following this logic, what do you think about the time classification of your income statement? Is it useful to analyze it for different time periods? Is it useful to look into the monthly income statements, for example? Indeed it is. Looking at the monthly income statements gives you an extremely useful insight. For example, you would be able to tell how your business performs over different time periods. This in turn has an implication on your business. For instance, if you have very low sales and business operations during winter, you can hire people on temporary basis for the spring and summer periods. This would result in lower annual expenses and therefore better business outcomes. Consider your credit suppliers as another example. Your credit period is limited. Therefore, it would be correct to place your orders just before the booming period and not before the slow period. Because otherwise, if you buy their products before the slow business time, you would lose valuable credit period. What we have learned so far is basic yet important classification, and there is more to come. However, that's it for this lesson. In the next lessons, we will look into different accounting aspects that will allow us to further study all classification factors. We will also look into the classification of the balance sheet. For this lesson, that was it. You can practice the exercise sheet that is available in the description below. That's all. I hope this lesson was useful to you.